Welcome everyone to SumZero again. We are going to be talking today with Hugh Dias from Navis Capital. Hugh is a China expert, and we spoke to him actually last July in 2022 to answer the question of whether China is uninvestable or not. And we wanted to follow up to just kind of get an update on the Chinese market, talk a little bit about some of the bigger tech names and a few other smaller ones. But Hugh, great to have you back. Always great to get your insights. I guess since our last conversation, a lot's happened in China, the most notable being the spy balloons incident. Maybe we can just start off with, like, if you can just give a quick summary of kind of what you think are the most important takeaways over the last, call it 7 months or so, and then we can dive a little deeper into some individual names as well.
Great to be talking to you again. I'm kind of interested that you should mention the balloon incident as a major thing. To me, it's a relatively minor thing. So at least for me, the biggest change has been the pivot away from the zero tolerance policies related to COVID. China's COVID policy was very harsh. It lasted for far longer than in any other country. Up until October, all the narrative suggested that they would stick to it for a long time. And then the pivot was very rapid. And it's a massive change. You cannot undertake normal economic activity when you're in a state of lockdown or possible lockdown. And now, the Chinese economy is reopened. So the pivot away from COVID is, very big and has a massive impact on economic activity. It's also representative, in my view, of a more pragmatic overall approach from the party towards a whole range of matters. The party allowed access to the US regulator to audit records. They have been, if you want, backpedaling a bit from some of the harsher crackdown measures on the tech and education sector. So the implementation rules have been softened. I guess when we spoke in July last year, Xi Jinping's main priority would have been re-election in October. And now his priority is stabilizing the economy. So there's a completely different mindset. China's also become more pragmatic in its relations with other countries. Wolf warrior diplomacy has been toned down. A lot of friendlier gestures have been made, particularly towards continental European countries and to Australia. So there's been a very big change in attitude. And in particular, economic activity can recover in the absence of, very harsh policies that have been suppressing it. Sorry, one more thing. There's another big change, but
just one thing that one of the most notable.
Go ahead.
Oh, sorry. I was going to ask. One of the most, dramatic moments in geopolitics recently was when he pulled Hu Jintao out of his seat back in October, and so I think that's when I was getting text messages from friends in the hedge fund industry who were like, "We can't invest in China now because he's sort of like almost like kind of graphically almost declared his authoritarian nature in a sense." How do you sort of reconcile that with the end of the zero tolerance policy? Or, was that a moment for you where you maybe questioned where China was staying and how friendly it might be to foreign investors?
Okay, so during the Communist Party Congress, all the messaging was very, if you want, harsh, and I would say very easy to interpret negatively, but it was politics. And what is surprising, and I guess shocked the market, was how rapidly more pragmatic policies basically were rolled out. And so I think in China, there's always a gap between if you want narrative and substance. And Chinese entrepreneurs know that very well, and they know they need to say the right thing, but behavior and action doesn't have to match with your words. And so if you look at the actions taken by the party in November and December, they're absolutely not consistent with the messaging that was given out at the Congress in October. But that shouldn't really be a big surprise because it's kind of always like that.
What would you say was the direct cause of that policy reversal?
Okay, so I think the policy reversal was always in the works. So the problem with the policy is it wasn't economically sustainable. And in particular, local governments were running out of money. Their revenue comes largely from land sales, and their costs had gone up a lot. And the policy had basically killed land sales. The expenses of all the testing and the lockdowns very high. And so local governments were running out of money. And so it wasn't the economically sustainable policy. It kind of had to change. Now, of course, there were kind of relatively widespread protests, which happened after people died in a fire in Xinjiang province, where many people, blamed the lockdown rules for the deaths of people. But I personally think that the party is not very good at listening to protests. If anything, when people protest, it tends to harden their resolve to go the other way. I think this change was always planned. It's just a question of when the official narrative was going to change. And so suddenly in November, you suddenly got messages, COVID's not so bad after all. That was when it became clear that the timing for the pivot was now politically correct, whereas previously it wasn't. But I think it had been planned for a long time.
And you don't see there being a risk of like other kind of non-COVID related policies, or maybe to rephrase, what are the non-COVID related policies that you could see being a risk to investing in China that would sort of put us back in the place we were as the zero COVID policy was being put in place? I mean, recently I saw him in the news. What was he in the news about? Like building a wall of steel around China, something that he was in the headlines for that. Kind of like military talk. And I'm just curious, have any of that is substantive or just more posturing in your opinion?
So, I think there's always a risk of surprises. And I guess in my view, the big overall risk with Xi Jinping is that he might prioritize ideology far more than pragmatism. And one of the strengths of the Chinese Communist Party over the last 40 years has really been their pragmatism. And in my view, what we've seen subsequent to October is a return to pragmatism. Could there be backsliding? Yes. But I'll go back to my early point is, people shouldn't pay that much attention to narrative, and they should look more at the actions. Kind of you shouldn't get stared by narrative that sounds unsettling. It's actions which undermine the economy that should be unsettling.
So the reversal on zero COVID, obviously a huge policy change. The Chinese markets, I mean, they kind of went up and then back down. I'm assuming your view is that the sort of intrinsic value of the Chinese market is not reflected in current stock prices, at least for I think in the past we've talked about Alibaba, and some of the bigger names like Baidu, but it might be instructive to go through some of these individual names again, to just see kind of where they're at today versus where they were last summer, and what has been reflected and what hasn't. So do you want to start with Alibaba, being being that it's obviously the most well-known name in China, just from a valuation standpoint, and kind of what's priced in and what maybe isn't, and then we can kind of dig in a little bit from there.
Sure. So, I think stock prices have been driven very much by sentiment rather than by the underlying fundamentals. And so I think, when we spoke in July last year, Alibaba might have been trading at about $100 an ADR. That was down about 2/3 from where it had been about 2 years earlier. Today it's about 80, so it's only a little bit up, but actually it bounced all the way from under 70 to 120 at the end of January. So if you're on reopening euphoria, added more than 70% to Alibaba's stock price. And that was really the expectation that would be in a kind of a more normal operating environment, a recovery of growth expectations, and the market started pricing that in. And then since the end of January, a whole series of things have depressed sentiment. First, there was the view in the US that inflation might be more persistent and interest rates might need to be higher for longer. And I guess that thinking has only recently changed because of the problems of Silicon Valley Bank. Then there was the balloon incidents, and I would say a ratcheting it up of all the narrative around geopolitical content and new rules to restrict China's access to semiconductors that could have dual use. And so there's been a ratcheting up of that. And then a kind of a big blow to sentiment, particularly related to Alibaba, was the announcement of a report that JD was going to launch a 10 billion RMB subsidy program. And that basically led to fears of price war in the Chinese e-commerce space. My perspective on that is that JD had quite a special advantage during COVID lockdowns because they're vertically integrated backwards with very strong logistics, whereas the other e-commerce players rely on third-party logistics providers. And as a result of the reopening, the third-party logistics providers are now much more reliable, and that kind of undermines an advantage that JD was enjoying. And in addition, Pinduoduo had started offering 3C products, which is JD's traditional strength. So JD basically, I think, have come up with the subsidy program as a defensive measure, and it's primarily trying to defend their kind of core strength against competitive threat from Pinduoduo. So I don't personally think that that's going to spill over into a price war with Alibaba.
So are you still, you're still bullish on Alibaba, given all the competitive?
Yes. So I think that if one's taking a 3 to 5 year view, there's I'd say a high probability that Alibaba could double or triple from today's price. And even if it tripled from today's price, it would still be less than it was 2 years ago. So it doesn't take, very much in terms of recovery of sentiment kind of to get there. The fact that it could go up 70% plus in 2 months kind of shows how quickly sentiment can recover. And of course, this is in the absence of evidence of a return to growth. But as we go into the second half of this year, we should start to see, increase in GMV, increase in revenues, benefits of operating leverage. Once all those things come through, it'll be much easier for sentiment to improve. And then maybe something like the balloon incident wouldn't have such an impact on stock prices.
That target of BABA tripling, does that factor in just the rates today? I mean, obviously we're in a much different rates environment than we were a year ago or even 7 months ago. So is that part of your own modeling and just how you discount Alibaba?
Okay, so I think that question is a very US-centric question, because obviously higher rates, it reduces stock prices, but China's macro statistics have decoupled from the US. And so Chinese inflation at the end of January was 2%. And so they don't have an inflation problem. They've not been increasing interest rates. With global interest rates going up, they might have to. But there hasn't been a mismatch between inflation and interest rates in China. And then the other thing about the mega Chinese stocks, if they have extraordinarily strong balance sheets. So they've had a cash cow business that's generated lots of cash, which has not been distributed to shareholders, basically sits in cash on the balance sheet, or has been invested in other investments or strategic initiatives. And so, to some extent, from a fundamental point of view, they're beneficiaries of rising interest rates, because at least they'll generate some earnings on their surplus cash assets, which were previously more or less dead assets, not contributing very much to earnings. Where, of course, in the US, most companies are leveraged, and rising interest rates will basically hurt their earnings.
We're getting a lot of questions actually on this call. One of which relates to BABA's accounting, and there have been numerous folks. I think Jim Chanos has been on TV a lot talking about aggressive accounting at BABA, and this goes back quite a number of years. What's your take on their accounting practices? Do you have any concerns there?
Okay, so I do have some concerns. I guess my main concern is the lack of granularity in the disclosures. And so it's really hard to do a very thorough sum of the parts analysis of BABA, because the segmental reporting is not that helpful. And in particular, in their Chinese e-commerce business, they have a whole bunch of, if you want, loss-making initiatives, which are part of their strategic initiatives, competing against Pinduoduo in group buying, going into the grocery area. Now, in the past, in the narrative on the quarterly results, they have disclosed the magnitude of the operating losses in those activities. So you could work out how much the traditional core business of Alibaba was making. But in recent quarters, they've not disclosed that. And so it's hard to do a very thorough analysis. However, my view would be that even if you took the most pessimistic possible interpretation, the share price is really bombed out, given the competitive position and the strength in the balance sheet.
I'll ask another somewhat US-centric question. So here in the US, especially with technology investors, I mean, AI has just taken over headlines. What is BABA's positioning in China, at least with respect to AI? Are they considered a leader? I know Baidu is a big part of that conversation as well, but where does BABA fit into the AI discussion?
Okay, so I think that Baidu is considered the leader in AI in China, and they're due to roll out their version of ChatGPT quite shortly. So we spoke earlier about the geopolitical conflict and the US, if you want, containment policy in terms of restricting semiconductor exports. And of course, AI requires very high-end specialist semiconductors. And I understand Baidu are having some trouble because of lack of access to those semiconductors. So we'll need to see how that plays out. But it seems to me that China will definitely have its own AI. But how effective it will be and how comparable it would be to the AI we see coming out of the US is an open question. We'll just have to see how that plays out. I don't perceive Alibaba as being at the forefront of AI, although of course they have their own initiatives in that area.
We got a question actually about China's relationship with Taiwan, whether it's practical or obviously, again, going back to the narrative. I mean, the narrative is one of aggression, but I'm curious if you have any updated thoughts on just how they perceive Taiwan. Maybe the conversation about semis relates. So curious what your thoughts are there.
Okay, so my view is that the way the war in the Ukraine has played out is very bad news for the Chinese Communist Party and their ambitions to reunify with Taiwan. So the point there is that invading an island is much more difficult than invading another country across a land border. The view, I guess, before Russia invaded Ukraine is that they had overwhelming force in their favor. And it's worked out very badly. So that would, I would say, give the party a lot of pause for thought. And the other surprise would be that the West has been relatively unified in terms of sanctions and other messages against Russia. Of course, China is way more integrated into the world economy. But I think all the lessons of the last year would basically make China much more cautious about aggressive actions towards Taiwan.
If the U.S. were to change its view on the war in Ukraine and maybe funnel fewer dollars there, because I know it, I'm just reading headlines, but Ron DeSantis has started to express views, that would seem to indicate that he's not as willing to fund the war in Ukraine. Obviously, Trump, he's not a huge fan of sending money to Ukraine, at least not of the blank check variety. If the U.S. were in the future to take that position, would you say that it would be easier for China to go ahead and or be more aggressive with respect to Taiwan, or do you think ultimately it's just more than they can chew, and it's not really, it's still not a likely event?
So my perspective is that China has very serious problems domestically. The economy was exceptionally weak, and many of the, if you want, non-pragmatic policies that were pursued over the last couple of years have created some structural damage to the economy. And so there's a really big job and challenge for the party in terms of reviving and strengthening the Chinese economy. And so to make a big push on Taiwan while the economy is still weak would just seem to me to be a very poor strategy. So I think they kind of have their hands full with domestic problems. And so I personally don't expect Taiwan to be a major risk area over the next kind of 3 to 5 years.
So last year you had pointed out that valuations in China were just so low that you could triple your money in sort of I think you quoted a 2-year time frame or a relatively short time frame. Can you just give us an example of kind of what you did in your own portfolio, during those, I don't know, you could use the summertime or even into the fall, where markets had sort of really struggled, where you had sort of taken advantage of that volatility and where some of those names stand today in your portfolio?
Okay, so there is an example of a stock that has already gone up about 4 times. And in fact, there are global players who participated in that and took advantage of the opportunity. And that is in the after-school tutoring sector. So, China introduced new regulations effectively banning after-school tutoring for curriculum subjects for younger students from kindergarten to grade 9. There are several listed companies in that sector, and stock prices came off, about 95%. And in the case of New Oriental Education, the market cap basically fell to about 50% of their net cash balances. And these companies had raised a lot of money in the market at quite good valuation, so they have very strong balance sheets. So in the case of New Oriental, they were quite transparent in terms of disclosing to the market what they were expecting. And they said, we expect half our business to go away, half our business will be unaffected. So they were going to have a whole bunch of restructuring costs. And then they also disclosed what they were planning on doing in terms of pivoting and starting new business operations to try and replace lost turnover. So we made a bet that the remaining business would end up viable. And so our view is that the share price was massively undervalued because there were 50 cents in the dollar and the business was being valued at nothing. So fast forward to today, the stock price is up about 4 times. The surprise on the upside is that one of their new initiatives has worked out very well. So they started a live streaming e-commerce business in the agricultural grocery space. And their particular niche was using people who are formerly English tutors to basically promote the product, and doing it in both English and Chinese, so that buyers would have an English lesson at the same time that they're shopping for groceries and agricultural produce. And that business has really taken off and is surprisingly high margin for a new e-commerce business. Now, of course, there's an open question to how sustainable that growth is going to be going forward. But they seem to have pulled a rabbit out of the hat. That was obviously not part of our investment case, but they have basically stabilized their core after-school tutoring business, and their new initiatives are going well, and the market's rewarded them for that. So that's in a case of kind of less than 12 months, something's gone up 4 times. So the main reason that type of multiple is possible is simply because the share price became so stupidly cheap. And if I look forward now, and so the next kind of 3 years, could New Oriental double from today's price? Perfectly possible. And if their growth in their live streaming e-commerce business proves to be sustainable, it'd still be cheap even if the share price doubled.
What multiple does it trade at today?
Okay, so it's kind of hard to say because there's a lot of seasonality in their education business. But whereas it was trading at about 50% of net cash, it's about double net cash today. if you do a sum of the parts, so the live streaming e-commerce business is separately listed through a company called Koolearn. And if you accept the market price on their stake in Koolearn, then the stock is still trading at a discount to net cash. So the question becomes whether the market price of Koolearn is overrated, and that's at a very high multiple. So it's a very strange thing. There's a very low multiple on the education business, a very high multiple on their nascent e-commerce business, and a ton of cash. But if you accept the multiple on the e-commerce business, then the stock is still trading at a discount to net cash.
Interesting. That sounds like a long discussion for another call. But we also had a question on electrification as it relates to China. So Baidu is obviously a big player in that space. Maybe, first of all, is Baidu a name that you own in your portfolio, or is it more of a name that you just follow kind of from the outside?
So we actually manage two funds, and our second fund, our first fund focuses on private equity and venture capital-backed companies, and our second fund is a Sharia-compliant version of that, but it has a more flexible investment mandate, and we actually own Baidu through our second fund because we think they're going to be a major beneficiary of the reopening. So one of the things that really got killed by the COVID policies is online advertising. Businesses became much more cautious with their advertising dollars. And with reopening, that should recover quite strongly. So Baidu should be a beneficiary of that. And then, of course, they have a whole number of initiatives in the AI area, which have a lot of upside potential, but it's kind of hard to say, what the outcome of those things would be. I would argue that kind of at today's share price, all those AI initiatives are more or less upside options. So you get an option and you're not paying much for it. Therefore, it's a kind of a good buy, but it's kind of hard to say ultimately what the value of those things might be.
Have you followed the news on TikTok ban, or thought through what that might mean for maybe multiples on Chinese names if TikTok were to get banned? Or is that another temporary, kind of headline that'll kind of come and go?
Okay, so ByteDance and TikTok is kind of unique in being the only major tech player who was very successful in the US market. So if you look at the other Chinese tech names, they're very successful in China, and then kind of they're big positions in Southeast Asia, but in other markets which are not the major developed markets of the world. So TikTok is kind of unique in being very successful in the US. So if they get banned in the US, I don't think it has much of an impact on the fundamentals of the other, big Chinese tech businesses. Their operations in the US are really negligible.
Yeah, I think that's fair. I think the question is whether it's just, there's like a spillover effect.
It's very hard to predict sentiment, and it could be a major negative for sentiment. I guess a point I want to make is that risk in financial markets is a bit like an iceberg. It's the icebergs you don't see which are more dangerous. And so the market's been so worried about all these Chinese risks. If we go back to July last year, very few people were talking about systemic risk in the US market. But if you look at what's happened, it turns out that the market was underestimating systemic risk in the US market. And investment is always a relative thing. So when people say, oh, I think China's uninvestable, what they're really saying is, I think compared to all the other markets that I could invest in, I can make better returns for less risk by staying out of China. And to me, that view underestimated risks in other places and is overemphasizing the risks in China. The risks in China are well understood.
A lot has been said about President Xi's sort of feelings towards, the education sector, but also the tech sector. We got a question actually about cybersecurity and security in general as being something that he's more of a fan of. Are there any names in that industry that you follow that you think are interesting from a valuation standpoint, or just even thoughts on that potentially being worth screening for folks who are interested in China and want to avoid the wrath of Xi Jinping?
So I believe that positive cash flow is a great mitigator. If sentiment deteriorates, but you invest in a business with very strong positive cash flows, then you have something. Then all you need is patience, and you can ride it out. And so the type of names I like are names which have very strong positive cash flows. They might also have a number of initiatives which are burning cash that could generate a lot of value, but the cash for those is underpinned by their cash cow. And so Alibaba and Baidu, I would say, excellent examples of that, where all their growth initiatives are funded by a very strong cash cow business. Therefore, you don't need to worry about the next round or anything like that. So at this point in time, I don't have kind of any stocks in the cybersecurity space that I'd say, oh, that to me is a kind of a no-brainer that I feel very comfortable with, because they lack this feature of being underpinned by very strong underlying cash flows.
That all makes sense. Is Alibaba your favorite name in your portfolio? I'm just curious what your number one position is.
No. So last time we spoke, I spoke about a company called Bairong, which is actually in the AI space. They provide big data and AI to Chinese banks to help them assess credit risk, and also to help them in terms of their online outreach to clients and potential clients. And that is, I'd say, a relatively small cap name. When we spoke last July, its enterprise value was approximately zero. But they announced a profit alert. And the content of their profit alert was that kind of normalized recurring profit had doubled in 2022, which would be a result would be surprising to many market participants because of the whole view that regulatory crackdown on the fintech sector has been very harsh, and therefore people would be massively struggling. But this is a company that basically doubled its profitability last year because of growth in its data analytics business. And that stock is trading at 3 times EV to EBITDA. So it's exceptionally cheap. It's a growth business in my view, a sexy sector. But it's
does it also have does Bairong have any Western VCs behind it, or is it fully kind of China backed?
No, it does have Western VCs behind it.
Cool. 3 times EBITDA sounds pretty cheap. What do you think is holding them back from just a multiple expansion standpoint?
So the share price has gone up and down with market sentiment, a little bit the same way the price of Alibaba and Baidu has gone up and down. So I think it's the overall drag of negative sentiment.
You know, also on the subject of kind of tech, the other big name is Tencent. The most recent headline I saw of theirs was it sounds like they're going to be distributing some version of Oculus or Quest Pro, or I don't know if it's the Pro or the two, but they're going to be. It looks like they're distributing VR headsets now. Have you done much work on Tencent as well? And you know, they're kind of the other side of the coin with respect to Baba. So I'm curious what your thoughts are on them.
Yeah, so I don't think I have any special insight to offer on Tencent. So I won't comment on Tencent.
Got it. Makes sense. The other thing that you know, people talk a lot about with respect to China, these, you know, kind of the real estate in China and sort of some of these ghost cities that have been built, you know, with no real populace. And just, I think people kind of question like the growth in China as, you know, kind of from a macro level. You get a lot of question marks around like what the true growth is. And I'm just curious how that impacts your own modeling and forecasts for cash flow for a lot of these companies. I mean, how do you diligence that? Like, what's your thought on that?
Okay, so I think there is scope for the party to manipulate economic data. And I think when the provinces send in their data, they always tend to exaggerate their growth. And I believe the central government then actually gives everything a haircut. But so, I'm not representing that all the economic data out of China is reliable, but the financials you get from many of the companies and the operating metrics is probably much more reliable. And kind of, to me, it's still obvious that if you look back over the last 20 years, the Chinese economy has grown faster and is a bigger proportion of the world economy than it was 20 years ago. It's likely to be even bigger in another 20 years. And the companies with unique, sustainable competitive advantages are going to grow and do well in that environment. So I would say, be fundamentals bottoms up. The argument for investing in China is not a macro top-down argument. Economic growth doesn't necessarily translate well into investment returns, but good fundamental performance and growing cash flows should translate into investment returns.
Yeah. One question I had, what would you say are kind of the main catalysts for Alibaba? And maybe this would be a good one to end on, just given that it's sort of the big liquid name that a lot of U.S. investors have access to. What would you say are the major catalysts coming up for what could unlock share price there? And maybe a timeline for those catalysts.
Okay. All right. So I think I think a return to growth and improved operating and financial numbers, I think would be important. So the market is, I guess, expecting improved numbers, but to actually see it. And then I think the other big thing is Ant Group and potential IPO or valuation event on Ant Group. Now, the Alibaba only discloses one single number, being the earnings contribution from Ant that they take into their P&L account, and that is actually lagged by 3 months. So when Alibaba reports for December, they're actually reporting Ant's results to September. And Ant is a little bit like Alibaba in that they have a massive investment portfolio. And in the third quarter, there was huge write-downs on the investment portfolio of both Alibaba and Ant. So the number that it's disclosed for Ant in the Alibaba statements is kind of meaningless because it's after all the impairment charges on the investment portfolio. So unless you're an insider, it's very hard to get a true picture into the underlying, recurring profitability of Ant after the restructuring. Now, in due course, more granular information on that should come out. But my personal, guess is that the latest number includes massive impairment charges on Ant's investment portfolio and doesn't, in fact, reflect the true ongoing performance of Ant. And at some point in time, there'll be more granular disclosure as to what's happening with Ant. And that could also be a catalyst for the share price.
So have you done any sort of fair value analysis on Ant itself? I mean, do you have a sense of like just, if you put a range on it, what you think that's worth today?
There's not enough information to do that exercise properly. So kind of, we knew what it was. The available numbers are not granular enough to do any meaningful analysis. So I guess the way I look at it is there's not much value for Ant in the current share price, so it's an upside option. But to say kind of, with any degree of, precision, what the value might be, the insiders will know. The insiders are buying back stock. Alibaba has a big stock buyback program. They can afford it, but the market doesn't know.
How big is their stock buyback program?
It's very large. They keep on increasing the size. I might get the number wrong, but I want to say it's like $50 billion or something like that. It started off at kind of, maybe 20 or 25, and, they more or less doubled it, something like that. So it's a big stock buy. So the point is they have a strong balance sheet. They have very strong cash flows from operations. They can afford to buy back their stock.
I think this is a good final question that somebody just posted. What do you think are the three big misperceptions on China?
Okay. All right. So the first one would be that the economy is centrally planned and that it is a communist system economically. So, my view is that China, in the private sector, outside of heavily regulated sectors, is kind of operates very much on free market lines. So that would be kind of one. Kind of the second point I would say is listening to the narrative you get from Communist Party officials and taking it very seriously. A lot of narrative is repeated because in a Chinese context, it's politically correct to say so. You need to mouth the right words, but that doesn't mean your actions align with the rhetoric. And I guess the biggest example of that would be the abrupt pivot away from COVID. If you listen to the narrative in October, you'd have said, well, there's going to be no pivot away from zero COVID for years, but there was. So it's taking the narrative at face value. The third one. I mean, maybe I'll stop there. I can't immediately think about it.
Well, I'll add. I think the thing that struck me was the lack of inflation in China. I think that's an interesting data point because, again, this is might sound U.S. centric, but we all we hear about in the U.S. is inflation. So we sort of assume that there's inflation everywhere. I mean, we know there is in Europe, but I think it's interesting that in China they've somehow managed it. So maybe that's kind of a third.
So that's a good point. So I guess in July last year, the view would be, macro management of the Chinese economy is awful. and in the US, it's so much better. So arguably, there's been excessive encouragement of risk-taking behavior in the US, creating some systemic risks. And over the last 4 years, we haven't seen that sort of behavior in China. And you don't have that same irrational exuberance. And so there are a lot of risks that people know about it. But the problems in Chinese banks, for example, are well known, whereas I guess the blow up of Silicon Valley Bank would have been a shock to people. They wouldn't have predicted it 6 months ago.
Yeah, what I learned was the discrepancy between how the G's, the systemically important banks in the U.S. are treated from a regulatory standpoint versus the smaller regional banks. And it's like it's a tale of two regulatory frameworks almost. So yeah, it wouldn't surprise me if like most of these regional banks are sitting on huge losses that haven't been realized and will, so maybe we end up seeing more of these Silicon Valley type failures. Who knows? But Hugh, this was super educational as always. Great to hear your thoughts and your perspective. I know you're obviously located outside the U.S. and you kind of get to see things we don't necessarily see so much here in the U.S. But always great to have you on, and looking forward to staying in touch and following the story. It's obviously an important one for folks in the U.S.
Well, thanks for your insightful questions.
Thanks, Hugh. Take care.
Bye-bye.